Your retirement savings, the money you've been putting away for 20, 30 years, was just used to buy a stock that lost nearly $5 billion last year. You made your coffee this morning. Everything felt normal, and nobody sent you a memo. And here's the crazy part. It wasn't a scam. It wasn't illegal. It was done using rules that were quietly rewritten just weeks before it happened. That is exactly what is happening right now with the SpaceX IPO. And in this video, I'm going to show you how they did it, why they did it, and what it could mean for your retirement. How your 401k works. Okay, so first, your 401k. Most Americans have a 401k. It's basically a piggy bank your employer gives you, except instead of sitting on your desk, it goes into the stock market. You don't pick individual stocks. Instead, your money goes into something called an index fund. Think of an index fund like a grocery basket. The basket has a rule. It must contain every item on a specific shopping list. That shopping list is called an index. The most famous ones are the S&P 500, the NASDAQ 100, and the Russell 1000. Your 401k fund manager doesn't decide what to buy. The list decides. And whatever gets added to the list, your fund must buy it. No questions, no vote, no choice. Wait, before you close this video, you need to hear what happened on May 1st. On June 12, 2026, SpaceX went public on the NASDAQ, ticker symbol SPCX. It raised $75 billion in a single day, $1.75 trillion. That is the total valuation, bigger than Saudi Aramco, bigger than Facebook, bigger than every American defense contractor combined. The stock opened at $135 a share. By the end of the first day, it was at $161. Then it kept going. It hit $225 within a week. Now, you might be thinking, okay, sounds like a massive success. What's the problem? What's actually inside SpaceX? The problem is what's hiding inside the SpaceX being sold to you. Here is what most people don't know. The SpaceX that just went public is not the SpaceX you think you know. Because in February 2026, just 4 months before this IPO, Elon Musk merged SpaceX with his other company, xAI. That's the company behind the Grok chatbot. It also owns X, formerly known as Twitter. So when you buy SpaceX today, you're not just buying rockets and Starlink, you're also buying Grok. You're buying X. You're buying an AI company that burned approximately $14 billion in cash in 2025 alone. In 1 year, gone. Like someone lit a match under it. Think of it this way. Imagine your favorite restaurant chain. It makes great food. The locations are packed. The profits are solid. Now imagine the owner secretly bought a movie studio that hasn't made a hit in years and is burning through money every single month. And then he merged it with the restaurant and said, "Here, buy this entire package at the highest price we've ever charged." That is the product. Rockets, losses, and a chatbot. Enjoy your retirement. Before xAI was merged in, SpaceX made $791 million in profit in 2024. After the merger, SpaceX lost $4.94 billion in 2025. That's a $5.7 billion swing in 1 year, caused almost entirely by xAI. And the losses are accelerating. In just the first 3 months of 2026, they lost $4.28 billion in a single quarter. So what you are being asked to buy at $1.75 trillion is a company that, according to its own SEC filing, said that profitability, and I'm quoting directly here, may never occur. They literally wrote that in their own documents. Drop a comment. Did you even know SpaceX was coming into your retirement fund? Because most people have no idea. Here's the magic trick. Morningstar, one of the most respected investment research firms in the world, values SpaceX at $780 billion. You're being asked to buy it at $1.75 trillion. That gap, $970 billion? That's not profit. That's the price of hype. Think of it like buying a used car where the sticker says $50,000, but the actual book value is $22,000. Someone is walking away rich. It's not you. How the rules were changed. This is the part that made my jaw drop, and once you see it, you can't unsee it. Because the question is, how exactly does a company that's losing billions of dollars end up inside your 401k? For that, we need to talk about the rules, or more specifically, the rules that were changed. Remember that grocery basket we talked about, the index fund? Well, the basket has rules about what can be added to it. Before this year, those rules had two important protections. First, a waiting period. Any new company had to wait up to 3 months before being considered for the index. This was like a probation period. Let the market figure out what the company is actually worth before forcing everyone to buy it. Second, something called the float requirement. The float is the percentage of shares actually available to the public. Think of it like pizza slices. If someone baked a pizza and only put 3 or 4 slices on the table for customers, while keeping the rest locked in the kitchen, that's a low float. SpaceX listed with only about 4 to 5% of its shares available to the public. The previous rule said you needed at least 10% to even qualify. Remember in The Wolf of Wall Street when they'd hype a stock just long enough to dump it? The mechanism here is legal. The result rhymes. But on May 1st, 2026, just 6 weeks before the IPO, NASDAQ announced something called the Fast Entry Rule, and it changed everything. The waiting period went from 3 months down to just 15 trading days. The float requirement was eliminated completely, and they added a bonus buying rule, which means funds are now required to buy even more SpaceX than the available supply would normally justify. A 4% float gets treated as if it were 12%. The Russell Index went even further, 5 trading days to enter. Now, remember, index funds don't choose. They just buy whatever is on the list. So the moment the rules changed, your 401k was on a countdown clock. Tell me in the comments if this feels legal to you, because technically it is. And that's exactly the problem. Think of Ocean's 11. They didn't rob the vault directly. They changed the security system, and the vault opened itself. Okay, but wait, isn't this a big deal? Were people raising alarms about this? Yes, loudly. The insiders needed a buyer. The rules were changed. Your 401k became the buyer. You are not the investor in this story. You are the exit. The American Federation of Teachers, a union representing 1.8 million members, wrote a letter to the SEC in May 2026 demanding, and I'm quoting, extraordinary scrutiny of this offering. Their president called the valuation, which she said was around 200 times cash flows, a figure that defies financial logic. She specifically warned that retirement accounts of their members could be pulled into SpaceX shares within days of listing without their active consent. That's like being told you're a shareholder in a company, except your vote counts as a whisper, and the CEO's vote counts as a foghorn. So yes, technically, you're a shareholder. Congratulations. Now, there is one hero in this story, and it's actually the S&P 500. On June 4th, 2026, S&P Dow Jones Indices rejected its own proposal to fast-track SpaceX into the S&P 500. They held the line. They said, our rules require 4 consecutive quarters of positive earnings and 12 months of trading history. SpaceX doesn't qualify. We're not making exceptions. So, if your 401k is built entirely around S&P 500 index funds like SPY, VOO, or IVV, you currently have 0 SpaceX exposure, and that won't change until at least mid-2027, and only if SpaceX actually turns consistently profitable. That one decision by the S&P protected millions of ordinary Americans from the most immediate version of this. But if your fund tracks the NASDAQ 100, the Russell 1000, or a total market fund like VTI, SpaceX is already arriving. According to Morningstar and Spot Gamma Research, the rule changes will force between $22 and $27 billion in automatic mechanical buying from those index trackers. Not because any fund manager decided SpaceX was a good deal, but because the rules require it. Here's the question everyone asks, and the answer is genuinely unsettling. How much of my retirement is actually at risk here? For now, the honest answer is the direct exposure is small. Because SpaceX listed with such a low float, its initial weight in most funds is under 1%. On a $100,000 portfolio, you're looking at maybe $100 to $200 worth of SpaceX for now. And all of this is happening while interest rates are still sitting above 4.5%. Treasury yields are rising. Foreign investors quietly sold a net $200 billion in U.S. bonds in early 2026. And the Fed is stuck. Cut rates and inflation comes back. Keep them high and the economy slows. Insiders don't pick random moments to cash out. They pick moments when they need liquidity fast. But here's why this story matters beyond just the numbers right now. Because SpaceX is not the last one in line. Anthropic, the AI company behind Claude, is expected to go public later in 2026. OpenAI is also planning its own listing. And both of them will benefit from the exact same fast entry rule changes. The same door that was opened for SpaceX is now open permanently for every mega IPO that comes after it. This is a structural change in how quickly enormous loss-making companies can enter your retirement fund. Now, does that mean it's going to crash? Nobody knows. SpaceX genuinely has extraordinary assets. Starlink generated $11.4 billion in revenue in 2025 with massive profit margins. The rocket business is real. Their lead over competitors in reusable rockets is, according to analysts at New Street Research, at least 10 years. So the technology is not fake. But here's the pattern that history keeps showing us. Dot-com bubble, railroads, fiber optic cable. The pattern is always the same. Technology wins. First, investors lose. This is exactly what happened in the dot-com era. You can watch it in HBO's Silicon Valley, played for comedy. Real investors in 2000 lived it as tragedy. The technology winning and the investors winning are two completely different things. SpaceX may genuinely change the world. Starlink already is. But the people who fund the dream at the highest price in history, that has never been the group that walks away rich. Not with railroads, not with fiber optic cables, not with the dot-com boom. The ones who win are always the ones who come in second after the dust settles and buy what's left at a fair price. First mover advantage is real. First investor advantage? Not so much. So, what can you actually do about this? 3 things. First, check what index funds are inside your 401k right now. If you hold a total market fund like VTI, a NASDAQ 100 fund like QQQ, or any target date fund, SpaceX is likely arriving soon if it hasn't already. If your primary fund is an S&P 500 fund like VOO or SPY, you're protected for now. Second, inside a 401k, you can generally move money between funds without triggering tax penalties. You're just reallocating within the same account. So if you want to shift toward S&P 500 only exposure, you can do that. Talk to your plan administrator. Third, and this is the most important one, pay attention to what happens next with Anthropic and OpenAI's IPOs. Because the rules are now set, the door is open, and it does not close. Here's the big picture question I want to leave you with. The rules protecting your retirement money from being used to buy loss-making companies at peak valuations, those rules existed for a reason. They were put in place after the dot-com crash, after millions of Americans watched their savings collapse. Tesla was public for 10 full years before it was allowed into the S&P 500. Those protections were changed in 6 weeks. One question before you go. Do you think the old rules protecting your 401k were removed to help you or to help someone else? Comment me or them. I'm reading everyone. And if this video helped you understand something that financial news made feel complicated, share it with someone who has a 401k because they probably have no idea any of this is happening. See you in the next one.